It appears as though this market is consolidating. It's kind of shifting sideways, stalling out a little bit. Is it any cause for worry, this notion that the markets aren't seeming to just go up, up, and away?
Absolutely not. In fact, the opposite. We think that this is a sign of a very healthy market. Consolidations are good. They give the market a chance to grow into its valuation. We started the year with valuations at the high end. Now what we've seen is S&P earnings estimates have come up to over $200 a share. While the market is still going up, but going up at a slower pace, that means the market multiple has come down to something in the low 20s, a very healthy rate with interest rates where they are. In addition, we've had an extraordinarily good earnings season. Earnings beats are running well over 80%. Revenue beats are running very high as well. And most importantly to us, orders across many industries are very, very strong, which bode incredibly well for continued economic growth as we look out not only the next 6 months, but into next year as well.
So Nancy, I'm just curious because over the course of the last month, we've seen some more outperformance from key parts of the market that are not considered to be perhaps as economically sensitive. I look towards things like utilities. I look towards things perhaps like real estate and elsewhere in the market. Is it perhaps a little bit worrisome that we are seeing some of those defensive, so-called defensive type sectors take a little bit more of a leadership role? I know that they're small in the market compared to technology. Still, though, is it a sign?
I don't think so. I think it's a sign that we continue to be in a market that sees rotation among sectors. And as sectors get oversold and out of favor, they then can rotate back into favor. And of course, we've also seen interest rates come down for a number of factors, some of which is, we believe, a recognition that, in fact, the inflation pressures will be somewhat more transitory than the market had believed a couple months ago. So we think that what is most positive is the continued strength that we're seeing both on the growth as well as on what we like to call the growth with the value side. So not deep value stocks, but good growth stocks at reasonable valuations that can continue to power the broad averages as well as some of the smaller averages higher.
I've heard so many portfolio managers talk about GARP, growth at a reasonable price. It seems to be that thing, that buzzword, that acronym that's come back into the kind of lexicon here in financial markets. So what kinds of companies are you looking at specifically that you think do provide that kind of growth at a reasonable price?
Well, so a lot of what we're looking at to find that is we're looking in places that are a little bit off the beaten track. What I mean by that is we're looking for suppliers into industries that have major growth trends, but that are supplying, if you will, the shovels to the coal miners, to the gold miners, as opposed to the gold prospectors themselves. One area that is looking incredibly promising are suppliers into electric vehicles. We heard what President Biden said yesterday about driving the growth of EVs in the U.S., both on cars as well as on trucks. And there are a number of players. One in particular is a company called Meritor, which supplies EV chassis to the trucks as well as to automobiles. These are companies that are selling at low double-digit multiples with secular growth as well as cyclical growth ahead of them.